The dream of running a business from home sounds like a financial no-brainer. No commercial lease, no secondary utilities, and a massive list of household expenses you can suddenly write off to lower your income tax. Done right, it's one of the cheapest ways to launch a company. Done wrong, a decision that saves you a few $100s today can quietly create a tax bill worth tens of thousands when you eventually sell your home. Today, we are analyzing the true cost of running a business from home. We are breaking down the running overhead you have to absorb, the exact math behind legal deductions, and the silent tax trap that can expose your house to the CRA. This is a live lab check on the home business model. Let's start with operational overhead. The moment you run equipment, whether it's high-draw computing servers or a kitchen oven running all day, your monthly household costs begin to climb. Utilities spike, and you face an immediate insurance blind spot. If you operate an undisclosed business from your home, you may find that parts of a claim are denied or your coverage is reduced, depending on your policy. To protect your home, many home-based businesses require an additional commercial endorsement, adding a fixed monthly cost to your operational overhead. To offset these costs, the CRA allows you to deduct a pro rata percentage of operating bills like hydro, heat, and internet. But you cannot claim an arbitrary number. For dedicated offices, the deduction is generally based strictly on square footage. For shared spaces, like a kitchen, both the size of the space and the amount of time it's used for business determine what you can claim. A space that represents 10% of your home but is only used 20 hours a week may qualify for only a small fraction of your household expenses, as long as your business remains a secondary, ancillary use of the property and you make no structural changes to the home. Your primary residence status generally stays completely intact. But many Canadians accidentally trigger a massive tax penalty because of a single checkbox in their DIY tax software. The software asks if you want to claim Capital Cost Allowance or depreciation on your workspace to maximize your refund. It looks like a harmless deduction. Your cursor hovers over that clean little checkbox. You click it to save a few $100 on your active income tax. That single click just completely changed the financial trajectory of your asset. Claiming Capital Cost Allowance on the building itself, not equipment or furniture, is one of the clearest ways to jeopardize your Principal Residence Exemption, because the CRA generally treats it as evidence that part of your property has officially been converted into a taxable income-producing asset. Let's run today's lab check. For this benchmark model, we'll look at an Ontario home purchased for $800,000. For this illustration, we're assuming the business use space remains a constant 15% throughout ownership, and the home appreciates over 10 years to $1.2 million, creating a total capital gain of $400,000. In scenario A, the tax-free blueprint, the owner writes off their pro rata operating expenses, but leaves building depreciation completely untouched. When they sell the house, their capital gains tax bill on the property is exactly zero. The entire $400,000 profit goes straight into their pocket, fully protected by the Principal Residence Exemption. Now look at scenario B, the taxable trap. In this specific illustration, we're assuming that claiming CCA results in the 15% business portion losing its full principal residence treatment under change in use rules. Watch what happens at sale, because that space was modeled as a depreciating commercial asset. 15% of the total $400,000 capital gain, which is $60,000, is now exposed. A taxable portion of that $60,000 gain will be included in your income under the specific rules in effect when you sell. heavily driven by your personal marginal tax rate that year. A minor annual write-off today can trigger an unpredictable tax liability at the closing table, completely wiping out the overhead savings of working from home. Keep an immaculate record of your hours, secure the proper insurance, and leave building depreciation untouched. Before you turn your home into a business asset, make sure your accounting can defend it. In the Canadian Wealth Lab, we don't look at tax write-offs in isolation. We analyse how today's deductions impact tomorrow's net worth. Subscribe to stay ahead of the curve. Assumptions change, opinions change, the math doesn't. See you next time.